This video is about working in retirement and your earnings limitations savings account. TRA retirees may return to work in a TRA-covered position and earn up to the earnings limitation of $46,000 without reducing their TRA pension benefit. If you exceed the limit, your pension may later be redirected to your earnings limitation savings account, or ELSA. Any non-TRA covered employment is not subject to an earnings limitation. A return to work agreement is only needed if you have a written or oral agreement in place before retiring. You must be at least age 62 when retiring to have this agreement in place. If you are working in retirement, TRA contributions will not be withheld from your new paycheck. The earnings limitation is applied to salary earned on a fiscal year basis. If you are under normal retirement age for the entire fiscal year, as defined by the Social Security Administration, the earnings limitation is $46,000. If you are under normal retirement age and are retired for only a portion of the year, the earnings limitation amount will be prorated. During the year you turn your Social Security normal retirement age, the limit is $46,000 for the portion of the year you were under that normal retirement age. Alternatively, if you are a Minnesota State retiree and on the Annuitant Employment Program, AEP, the earnings limitation is $62,000 for the fiscal year. It is not prorated for the first year of retirement or for the year you reach your normal retirement age. The only time the AEP earnings limitation is prorated is if you retire in the same year you reach normal retirement age. This program is administered by the Minnesota State Human Resources. If you earn salary over this limit, your annuity payment is reduced the following year by $1 for every $2 above the limit. Your benefit will be reduced or stopped beginning in January of the following year until your entire amount has been withheld. Each year, you will receive an ELSA annual statement, which is the comprehensive report of your savings plan for each calendar year. At any time, you can log into your MyTRA account online and view your ELSA account. Here is how your earnings limitation savings account works. If you retire in June, and then in September you go back to work teaching in a TRA-covered position, and your earnings will be more than $46,000, then in January of the year following that school year, we should begin withholding pension checks until half of the overage is transferred to your ELSA. 1 year after the final amount is transferred to ELSA, you may apply for a refund of that account. This process repeats every fiscal year you work and earn more than $46,000. You may apply for a refund of your ELSA account beginning 1 year after the last deferred amount was redirected to this account. It does not earn interest. If you have chosen a pension with an accelerated annuity, the accelerated portion is not withheld. You must submit an ELSA refund application to TRA to receive your account balance. When you request a refund, you will receive a full eligible amount. Partial refunds are not available. You may elect to have all or any portion of your ELSA refund payment rolled over to a traditional IRA or an eligible employer plan. You can also convert your refund to a Roth IRA. Some tax implications apply. You may also elect to receive a lump sum refund, minus applicable taxes. We suggest you consult a tax advisor regarding any tax implications. If you choose to receive a lump sum, the distribution will be reported on IRS Form 1099-R as a normal annuity payment. If you apply for a refund and then return to work, the earnings limit will apply to that reemployment salary as well. You will need to apply for another refund 1 year after the second period of deduction ends. You will receive a letter the first week in December if we are withholding your benefit for exceeding the earnings limitation. This letter will explain the expected adjustments to your pension in January. Let's look at the example from earlier in greater detail. This example assumes the retiree has been retired for more than 1 year, is more than 1 year younger than Social Security normal retirement age, has a monthly TRA benefit payment of $2,000, has post-retirement fiscal year earnings of $56,000 in a TRA covered employer. TRA would take the $56,000 fiscal year earnings and subtract the $46,000 earnings limit. That would give you $10,000 in excess of the limit. To withhold half of the excess earnings, we divide by 2 and find we need to withhold $5,000 from the following year's pension payments. When we see this month by month, we see that TRA would transfer January, February, and half of March's $2,000 payments to the ELSA. The other $1,000 for March and the remainder of the year's pension payments would be paid out as usual. This individual is first eligible to apply for a refund of the $5,000 that was transferred to the ELSA savings account 1 year after March 1. The beneficiary designation you make for your ELSA account is a separate designation from your retirement pension. In the event of your death prior to receiving a distribution from your ELSA account, and upon application by your beneficiaries, a lump sum payment of your ELSA balance will be distributed. As outlined in Minnesota Statutes 356.47, payment will be made in the following order: to a surviving spouse, to designated beneficiaries, and your estate. If you are not married and wish to designate a beneficiary, or if you wish to designate a beneficiary in the event of your spouse's death, you may designate any persons, trusts, or organizations as your beneficiaries. It is important to keep your beneficiary designation up to date. Contact TRA to request an earnings limitation savings account beneficiary designation form. Please call, chat with us on our website, or send us a secure message in your online portal if you have any questions. Thanks for watching today.